Here is the section 1. It says your calendar year company places the following orders on December 27th. Indicate which of the orders will be reflected on this year's financial statements. So we have two types of shipping method. It is either, and it will be on the invoice. Either will be based on FOB shipping point or will be based on FOB destination. Based on FOB shipping point, from the shipping point, the buyer is responsible for the shipping and the buyer owns the inventory from that moment. Okay? But under FOB destination, until the final destination, the seller is the owner of the inventory and the seller will pay for the shipping. Make sense? So, goods shipped December 28th, FOB shipping point, and received on January 2nd. Because it's FOB shipping point, then from the shipping point, which is December 28th, it's already the buyer's inventory. Doesn't matter when it will arrive. Absolutely no problem when it arrives. The question is when it's shipped because it's FOB shipping point. So title passes to your company at the shipping point on December 28th. Therefore, this inventory will be included in the year's financial statement. It should be in the balance sheet. And we call that inventory in transit. Goods shipped on December 27th, FOB destination, and received on January 4th. You see, based on FOB destination, until final destination, the seller is the owner, and the seller pays also for shipping. So it up to January 4th, the seller is the owner of this inventory. Because title passes to your company when the goods are delivered on January 4th, this inventory will not appear in this year's financial statements. It is still part of seller's balance sheet, not the buyer. So goods shipped on January 2nd, FOB shipping point, and received on January 8th. Okay, FOB shipping point is good, but look at the date. It is January 2nd. So it's too late anyway. Even though January 2nd is your point of reference because it's FOB shipping point, but too late. So the title passes to your company at the shipping point on January 2nd. Therefore, this inventory will not be included in this year's financial statements. So it's easy, not big deal, but you need to know both of these terms. Goods shipped FOB destination December 28th and received December 30th. So FOB destination December 28th and received on December 30th. So that's good. FOB destination is December 30th, the delivery date, which is good enough. It is here before the end of the year, and title passes to your company when the goods are delivered on December 30th. Therefore, this inventory will be included in the year's financial statements. That's good, section 1. And let's move on to another question. Your company places the following orders on September 25th. Indicate which orders will be reflected on the balance sheet for the years ended September 30th. So goods are shipped FOB destination September 28th and arrives on September 30th. So that's good. End of the year is September 30th. It is here by September 30th. So because title passes to your company when the goods are received on September 30th, therefore the inventory will be included in the year's financial statements for your company. Goods are shipped FOB destination September 27th and received, October 2. That's too late. Because title passes to your company when the goods are delivered on October 2, this inventory will not appear in your financial statements because based on FOB destination, title passes on October 2nd when it gets to final destination. Goods are shipped FOB shipping point September 28th and received October 2nd. FOB shipping September 28th. You see, from the shipping point, it's yours. So September 28th is the date the title transferred. So therefore, this inventory will be included in the financial statements. Goods are shipped FOB shipping point October 1st and received October 3rd. No matter what, FOB shipping point October 1st is too late. That's our date, but it's too late. So a title passes to your company at the shipping point of October 1st. Therefore, this inventory will not be included in this year's financial statement. Okay, let's go one more question. Number 3. XYZ orders goods costing $5,000 from ABC. So ABC is seller, XYZ is buyer. A trucker charges $300 for shipping. What amount will XYZ, the buyer, records as the purchase cost in each of the following cases? First, FOB destination with freight paid in advance by ABC. So because ABC pays for shipping, that means seller is paying for shipping. That is FOB destination. Seller is responsible to pay for shipping. And therefore, XYZ records inventory only at $5,000, the only cost that ends up XYZ to pay. Nothing more, nothing less. FOB shipping point with the freight cost added to ABC invoice. So because it's FOB shipping point, that means the buyer, XYZ, the buyer is responsible for paying for shipping, right? And ABC is the seller. ABC has a very good deal with shipping company, so they order the shipping, whatever it might be, $300, and they will add that to invoice, so the buyer pays for the shipping because it's FOB shipping point. So XYZ, the buyer, pays for shipping, so it must record inventory at $5,000 plus $300 shipping cost. That's $5,300. FOB shipping point with XYZ paying the shipping cost upon delivery. Because it's, again, FOB shipping point, that means buyer, XYZ, is responsible to pay for the shipping no matter what. So, again, XYZ needs to recognize that the cost of inventory is $5,000 plus $300 shipping. That's, again, $5,300. Let's look at number 4. So the beginning inventory, I'm going to do one of them and then you figure out the rest anyway. So beginning inventory for a company A is $10,000. What we are doing here is doing base, B-A-A-S-E, beginning, added, available, subtract, end, B-A-A-S-E, beginning, added, available, subtract, E, end, B-A-A-S-E. And use that B-A-A-S-E for literally so many things in accounting. So learn it, apply it to this course, to another accounting course, to your CPA exam. that will be a time saver. All you need to do is just having a notepad, just write VAASE, plug in these numbers, get the number is missing, move on to the next question. So here is the beginning 10, purchase is 20. That means available is $30,000 of inventory. So far so good, like t-shirt, $30,000 worth of t-shirt. So how much t-shirts do you have? $30,000 available t-shirt. Okay. Now at the end of the year, you go to the inventory room and you count your inventory, which companies always do that. And they figure out after counting for many hours, maybe the whole night, they figure out that there is $5,000 worth of inventory left. Okay, so available of 30, less left over ending inventory of $5,000. The difference has been normally what? Sold, right? So you call it cost of goods sold, $25,000. Got it? And then you apply the same thing for the rest of these scenarios, okay? In some scenarios, you have to go reverse. Let's say E. The beginning is missing, the available is missing, so you have to go from below and go all the way up. So cost of goods sold is 12, end is 9, so 9 plus 12 is 21 available. If 21 is available, so 21 available minus purchases of 16, that means you have $5,000 beginning inventory. So you go the other way, all the way up. Okay. If you are good on this problem, then let's move on to another one. In section 2, we are talking about inventory record keeping using the perpetual method. So we have two types of accounting method for inventory, either perpetual method or periodic method. Perpetual method, that means perpetually, every moment, using a software, you can see how much cost of goods sold you have, what is your end inventory, and all those information is available to you because you are using a software. So as long as you can afford that software, which has different prices based on the level of complexity in your merchandising business, then everything is good because it gives you a lot of information. The other method is periodic. That means in periodic method, you don't need a software. And periodically, which is probably end of the month or end of the quarter or at the latest end of the year, you will see what is left in your inventory. And by understanding base, B-A-A-S-E, beginning, added, available, subtract, end, you can calculate what the cost of goods sold might be. And because you did end inventory calculation, counting, then you also update your inventory T account. Under perpetual method, listen carefully, under perpetual method, your inventory T account is constantly updated. January 1st, then January 10, January 30th, February, March, all the way. Every single moment, your inventory T account is updated because you are using a software. However, under periodic method, the inventory T account always shows what is in it as of last year, December 31st. It will never get updated until you do inventory count at the end of the year. Okay, so if the inventory is not updated, it's always not giving you, accurate information. So you just update it at the end of the year. Cost of goods sold, you never know what it is till end of the year. But under perpetual method, Because you are using a software, guess what? The cost of goods sold is clear and available at any given moment. So let's focus on the perpetual method. Under perpetual method, you always buy inventory, you put it in inventory T account. If you sell inventory, you take it from inventory T account. If you have a return of merchandise you sold, you put it back in the inventory T account. If anything is like damaged, inventory damage, take it out of the inventory T account. So your inventory T account is gonna be used all day long. So perpetual inventory T account all day long. Okay, let's go to first problem. On July 13th, company orders inventory with an invoice of $20,000. FOB destination. So that means the cost of inventory is 20, but they are not going to pay for any shipping whatsoever. On July 17th, the goods and invoice are received. So July 17th is your date of receiving and recognizing the inventory in your balance sheet. Not July 13th is useless because it's up to July 17th, it's the seller's property because it's FOB destination. On July 21st, company pays the invoice in full, which is good. On July 30th, the inventory is sold on account for $30,000. So the cost of goods sold will be recognized. Prepare the journal entry to record cash transaction, to record each transaction under the perpetual method. As I said, under perpetual method, every time inventory T account will get updated. So on July 17th, not any other date, July 17th, you update your inventory by $20,000 debit. So asset, current asset, inventory T account will increase and liability will be recognized. On July 21st, you pay for the inventory. So cash will be credited to pay the cost of the inventory you purchased, and you close the accounts payable. So debit accounts payable and credit cash. Now, on July 30th, you sold that inventory to your customer. And when you sell it under perpetual method, you need to do 2 journal entries. Under periodic method, you just do this journal entry number 1. This is periodic, and this is the only method only journal entry you do. Under perpetual, you not only do this journal entry as journal entry number 1, but immediately you do journal entry number 2, which is recognition of cost of goods sold and adjusting inventory. So number 1, journal entry at the time of sale is recognition of accounts receivable debit or cash debit, whichever it is, and sales revenue credit. Journal entry number 2, immediately cost of goods sold will go up by $20,000. That's the cost of inventory you sold. And inventory will be reduced in the T account by $20,000. That's a credit. Hopefully it's clear. If you are good, then let's move on to next question. Cook Enterprises orders inventory from Advantage FOB shipping point. So if it's FOB shipping point, that means the buyer needs to pay for the shipping, and the buyer owns this inventory from the shipping point. The item is list for $10,000, which is list price, but Cook gets a 5% trade discount. A 5% trade discount, that means an immediate discount. And it's very common. And if you go to, let's say, mall, you see Macy's has a big banner in front says Mother's Day sell 20% discount. That's a trade discount. That means you go in, whatever you touch, there is 20% trade discount. So technically your purchase price will never ever be the list price, just same as here. So the purchase price is never the list price. It is list price less 5%. Freight is $150, so that will be added at the top of the cost, because it's FOB shipping, which Cook pays the trucker upon delivery. Before paying the invoice, Cook notices that goods were damaged and returns the entire shipment back. Prepare the journal entry to record each transaction under the perpetual method. Okay, under perpetual method, we record this in inventory. Remember? Perpetual inventory. So inventory will be debited for $9,650, which is $9,500 for the merchandise and $150 for the shipping. So it ends up to be an inventory value of $9,650. $150 will be paid cash to the trucking company, and $9,500 will be recognized as liabilities, so we can pay later on. So far, so good? Now, we are going to send the whole inventory back because it's damaged. So we're gonna close the liability, okay? Accounts payable will be debited to close. The $150 of inventory here that you were so happy to have it now has to go somewhere else. So you put it in, let's say, miscellaneous expense, okay? Therefore, inventory will be totally reduced by $9,650 that we recognized already once in here. Now it will be credited to take that inventory back to whatever it was before. So $150 that we paid for shipping ends up to be miscellaneous expense. Okay. Number 3. Company purchases goods with an invoice price of $4,200. And terms, 310 net 30. 310 net 30, it's a term of payment. That means 30% discount if it's paid within 10 days. If not, the net amount, the total net amount is due within the next 30 days from the invoice date. And this 30%, it is a very big deal, very important. You always want to take advantage of this type of terms of payment. And these terms might be different terms. It's not supposed to be always the same term. It might be 210 net 30. It might be 110 net 30. It might be 315 net 60. So the terms are changing, but the important is that you need to take advantage of it. This is a big deal, 3%. It's a big issue, so you really want to, understand that this is an important problem. So, in order just to understand how to calculate this, I like to teach you this. So let's do this. Let's do this. I am going to use my camera and show you that how important it is and why you need to take advantage of these offers. In the same time, I'm going to teach you a way of algebra calculation that it will be useful for so many things in business, in accounting, in normal life. So here we go. Whatever you have, put it at the top. So you have percentage, let's say, and you have days. Okay, anything, even in a business, in a daily life. Whatever information you have, put it one on the left side, one on the right side. Then you say, okay, they are offering, this is a deal that it is 310 net 30. So we're gonna use 3% of discount if we pay between 10 days and 30 days is 20 days. So if we pay 20 days sooner, then we can save 3%. So 3% is for 20 days of, paying sooner, 3% for 20 days. However, that doesn't make sense to us until we turn this to 300, let's say 65 days or 360, whichever you like. So let's say 360 to make it easy. In 1 year, we have 300, let's say 60 days. So the annual interest rate that they are charging us, if we don't pay within 10 days, is how much? That's how you understand what it really means. So these two are available. So you multiply these two, and then you divide to the one that is single. There is nothing on the other side. So those two are available, multiply, divide by the single one sitting here. So it will be 360 times 3 divided by 20. And the answer will be 360 times 3 divided by 20. That's 54%. 54% annual interest rate. That's crazy. 54% annual interest rate, it's crazy amount of interest. So you are much better position if you borrow money from any bank for 10%, let's say, and pay this in 10 days and never ever pay 54% of annual interest rate. Make sense? Good. So this is something that I want you to learn. It's a simple algebra and use it. I'm going to give you another example just since we are here, and you will not see this again in any class anyway. So this is your only opportunity. So here we go. Let's say you have something related to business. Cash flow. Let's say you have a cash flow from your operation, operating cash flow from your daily business operation of, let's say, $10,000. So cash flow is $10,000, and your annual sales is, let's say, $400,000. So because of $400,000 annual sales, right, you have $10,000 cash flow from your operating activities. Now you want to create a budget for the next year. And in the budget of next year, you have also to prepare a cash flow statement, and you want to kind of see how much your operating cash flow would be for that budget. Okay, For next year, because the economy is good and everything is going towards positive, so you think next year your annual sales will be about $450,000. And now you're trying to figure out what would be your possible operating cash flow from that. But you don't know that, obviously, right? And you're trying to make a budget. So this is a very quick and tricky way to figure out and get the job done in very short time. And people will say, how do you know that? But don't tell them. You just do your math and get the job done, and your budget is ready. So here we go. Those two numbers are ready. So you multiply those, and then divide. Okay. So $450,000 multiplied by $10,000 divided by $400,000. So far, so good. So what would be the answer? So 450, 1, 2, 3, 4. No, it's too much. Let's make it easy. This 3 zeros goes with this 3 zeros, so it's 450. So here, 450 times $10,000 divided by 400. That's 11,250. 11,250. So your operating cash flow will be 11,250 for the next year estimated. Got it? So based on the estimation, you easily fill up your budget and you go forward and your budget is ready. Doing just a simple thing that I said, algebra. Okay, so remember this, specifically remember that, and it will be very important to understand why on earth you need to pay this within 10 days, no matter what. Okay, if there is no question, let me turn off the camera and we go back to the problem. Okay. So inventory is $4,200. 310 net 30 is the term of payment, and pays the net amount in 8 days. That means smart company, they take advantage of this offer of terms of payment, and they want to use to pay as less as possible. There's two ways that you record this type of transactions in accounting. We have a gross method, we have a net method. In the gross method, you go with the gross amount of inventory that you purchased, which is $4,200 debit inventory and credit liability. So far, so good, your inventory is still updated. Then you need to close the liability within 10 days. So you're gonna close that liability and you're gonna reduce the inventory by $126 because of that saving that they offered to you. And you only pay $4,074. That's the only cash check that you're gonna write and send them. So inventory will be reduced, adjusted by $126, and liability $4,200 will be paid, and that's a gross method of doing journal entries. The net method of doing journal entries, it is, as you see here, a little bit different. How it is this. You say, okay, in the net method, we always calculate what is the net amount of payment that we're gonna send. So at the beginning, you decide the inventory is only $4,074 because your company is always smart enough to take care of these payments within 10 days. So inventory will be only 4,074, which is 4,200 minus 126, right? And accounts payable is exactly 4,074. And because your company is paying on time, at the time of payment, you have one very simple journal entry right there. Accounts payable will be closed, $4,074, and you write a check for $4,074. As you see, in the net method, because your initial journal entry is in the net, then your accounts payable department will look at the accounts payable and they know exactly how much they need to pay because they always pay within 10 days, no matter what. So this is an easy kind of way to do it. But in a previous one, you see the accounts payable department, when they are paying this, they have to be careful. They have to say, oh, yes, I know it's payable is $4,200, but terms of payment will save us $126. So we're gonna reduce the inventory by that amount and only send a check for $4,074. So this needs a little bit smart accounts payable department, right? To make sure they do this properly. But if your accounts payable department is always paying on time, so net method may be also a good way to do it. Either way you do it, it's fine. Results is same, and inventory is still $4,074 showing. So either way is fine. Just your job is to understand what is a gross method in this scenario and what would be the net method in this scenario. Okay. Good times purchase goods with an invoice price of $6,300 and terms of 210 net 30. So pay in 10 days, save 2%. Otherwise, the whole amount of $6,300 is due in 30 days. It pays the full amount after 15 days. Oops, that's not good. Prepare the journal entry to record the purchase and payment if good times record cash discounts. Okay. At gross. So at gross, you record the inventory for the whole gross amount of $6,300. You record the liability for $6,300. So inventory will be debited. Liability accounts payable will be credited. And then because you paid late, then 10 days, guess what? There's no discount. So the journal entry will be accounts payable needs to be closed for $6,300. And you pay a full amount of $6,300 to close that liability. That's gross. In net method, you first record the inventory only based on the net amount after discount, which is $6,174. And you record a liability for that $6,174. Unfortunately, your company missed the deadline to pay that within 10 days. So what's your company gonna do? Then your company gonna pay a penalty, it looks like, right? So that's accounts payable of $6,174 that needs to be closed. And your company ends up to pay the interest expense of $126 for this issue, because paid after 10 days, and cash will be paid for $6,300. This purchase discount, lost, so-called, or interest expense, will be added back to, kind of cost of goods sold, because this is a extra money that you paid for the value of the inventory that you purchased. So technically, this purchase discount loss, one idea is to just close it into cost of goods sold. So your cost of goods sold will properly reflect $6,300 of inventory that has been sold. Okay. So this is when your accounts payable department mess up the whole thing, and you end up by paying such a high interest rate. This interest rate, based on the way I calculated, if you do it, you will see it is 36 or 36.5% annual interest rate. 36% if you count 360 days in 1 year. If you count 365 days in 1 year, it will be 36.5% annual interest rate. That's a crazy amount of interest rate. So this company messed up big time. Number 5. The company sells 500 units of inventory for $12,000 on account. On account, that means accounts receivable. The units cost $10 each. The customer returns 50 units before paying the invoice. Prepare the journal entries to record each transaction under perpetual method. So if you sell something, good for you. You record accounts receivable, which is selling on account. That's a debit. And sales revenue, credit. However, remember, this is a perpetual method. So under perpetual method, you have to record not only what you sold, but also the cost of goods sold and inventory adjustment. So journal entry number 2 will be debiting cost of goods sold for $5,000, which is 500 units times $10. And inventory will be reduced by $5,000. Okay, so inventory goes down, cost of goods sold goes up, accounts receivable goes up, and sales revenue goes up. But the customer returns 50. Okay. If the customer returns, don't debit sales revenue. Leave it the way it is, because you want to show and management want to see how much sales revenue is. You don't want to debit credit that sales revenue to mess up the data. So leave it the way it is. Create a contra account to sales. There are three type of contra account to sales: sales discount, sales returns and sales allowances. Sometimes they call it sales returns and allowances as one T account, but in general you might want to, I suggest, separate them. So your sales revenue will have 3 contra accounts: sales discount, sales returns, and sales allowances. What is sales discount? Sales discount is the discount that you offer to your client to pay within 10 days and save, let's say, 2%. Like this one, you see? When a company is offering you a term like this, for the seller, this becomes sales discount. Okay? Same thing. So here, so because of the seller offered sales discount, so sales discount is a contra account to sales revenue. Sales returns, that means the customer returned physically the sum of the merchandise. That goes again in the debit side, and it will be a contra account to sales revenue. Sales allowance, that means the customer is not returning physically, but is calling you and complaining about the quality or whatever about the product, and you offer them some allowances to pay less, and that goes in sales allowance. So here we have a sales returns. So in the contra account of sales revenue, called sales returns, we debit that for $1,200, and accounts receivable will be kind of going down. So we have less accounts receivable. After doing that, because it's a perpetual method, that's journal entry number 1. Perpetual method, you need to do 2 journal entries. That means you put the inventory back in its place by $500, which is the cost, $50 times 10, right? $50 times 10, that's $500 goes back into inventory account, and the cost of goods sold will be reduced by that cost, which is 50 units times 10. So when you on the perpetual method, if you sell an inventory, you have 2 journal entries. If you have a sales return, you have 2 journal entries. How about if it is sales allowance? Okay, if it is sales allowance, then you don't have a physical return. So automatically this part, this journal entry will not be done. All you need to do is just debit sales allowance for $1,200 and credit accounts receivable. Got it? But because this is actual return, so you have to do 2 journal entries. Okay. Now, question for you. What is net sales? Net sales is sales, $12,000, less sales allowance of $1,200. So net sales is 12,000 minus 1,200. That's 10,800. Got it? What is accounts receivable balance at the end of this scenario? Accounts receivable balance will be $12,000 on the debit side, less $1,200 on the credit side. So accounts receivable balance is $10,800. Make sense? Okay, looks like we are good. And that's section 3. Okay, we are good. So section 1 and 2, we done both sections. We should be good for today. Please study your book. Your book has a lot of problems with solutions given to you, quizzes with the solution given to you. Make sure you go over those problems and given solutions so you can practice your understanding and see where you are having some issues, so you can focus on that part. Go over these problems, solve them, and look at my solutions that I gave you and see again if you are in good standing or not. Okay? See you next time for the next section.